Hi, today we are going to talk about, we are going to start a new topic, sources of short-term financing. So here we are going to go over the following topics. The first one, trade credit from supplier, is the most available short-term financing. So why is that so? When your business needs money, when can it get the money from? Well, you can find credit suppliers as a short-term financing source or lenders. What does it mean? Accounts payable is the most common short-term credit. Sometimes it's overlooked. If we are in retail business, the producer of the goods that we sell is the primary lender in our business in the form of accounts payable. It's actually more than 40% of short-term financing sources. So for the payment period, 30 days is acceptable, 35, 40 days is still good. But if you go beyond 60 days, you maybe alter your relationship with your suppliers. So next time, maybe he will not supply to you in, the goods and services that you need to stay in business. So that's a very important source of short-term financing. Another one is bank loans. We are going to discuss there are lots of types of bank loans with compensating balance. We have discounted type of loans when you have to pay the interest up front. Installment loans like the ones we have when we buy a car and so forth. So we are going to look into all type of bank loans, and as a business you have to shop around and find the best type of loan for you. Commercial paper is another short-term type of financing. In this one, the businesses who need money, they can issue short-term type of paper assets or marketable securities. That's called commercial paper. And then when they are due, they have to pay back the money from that they took initially from the investors plus some interest. Also, another way to receive short-term financing is using accounts receivable and inventory as a collateral for a larger loan. Well, that can be a very expensive type of loan financing. Um, so basically, those are all the choices that businesses have, and we are going to conclude with a discussion about risk return relationship and what's the best way to hedge against risk. So, the first topic is trade credit. Trade credit, they are more than 40%, account for more than 40% of short term financing. As I explained earlier, relationship uh, between businesses. So this is considered accounts payable is considered a spontaneous source of funds because if your business allows you to pay in 60 days rather than 30 days, you have a 30 days extra time to grow your business before you actually have to pay back your accounts payable. So that's an important one. And let's see how this type of financing works. So when we have an extension of 30 more days in trade credit, you have to make sure that you meet this requirement. Don't go beyond 60 days if you are approved for 60 days, because then you can alienate your suppliers. And then remember, when we discussed in previous chapter, you have a credit score, and if you don't follow your obligations on time, then you might have a decrease in your credit score as a business. So, major variable in determining payment period is the possibility of the business offering you a cash discount. That's common practice. Sometimes, if the business uh, needs the money fast to pay their bills, they might offer you a cash discount. So if you are offered this cash discount, for example, 210 net 30 means that you'll have to, if you take this cash discount, then you only pay 98% of how much you owe, but you have to pay it in first 10 days. Otherwise, if you pass this cash discount, that means you have to pay everything in 30 days. So think about it. Suppose you owe a million to a business in accounts payable. What's 22% of a million? 2% of a million is 20,000. So if you decide to take the cash discount, you don't have to pay this 20,000. You just pay a million minus 20,000. And it can add up, especially for big numbers. So then you have to figure out, should I go for the cash discount or not? Well, when you make these decisions, you have to take in consideration what is the cost of failing to take the cash discount. Think about it as a penalty. What does it mean? How much it's going to cost you in percentage? In percentage, if you pass that cash discount that you are offered, what would be the penalty in percentage for you? And we are going to do some calculations next in the application portion of a new recording. But suppose that this cost of failing to take a cash discount comes out to be, let's say, 20%. That's a big number. That's a big penalty. That means, well, I'm not going to pay my bill in 10 days, 98%. I'm going to pass it and pay it in 30 days, everything I owe. Well, that's a big penalty. Now, suppose you say, yes, I know it's a big penalty, 20%, but I don't have the money to take this cash discount. Well, what if you look around at the bank and you find the bank you can borrow money at 5%? 5% cost of borrowing interest rate, it's much less than 20%. What's the penalty here? So in this case, you would be better off to borrow the money at 5% and take the cash discount, avoid this penalty of 20% that we had in as an example here. So this is how you go about thinking about this decision. Sometimes if the penalty here comes out to be a lower number, let's say 4%, then and the interest rate at the bank is 5%, then you might be better off with passing the cash discount. And one more idea in relation to trade credit. A business can be considered net credit position. It can be considered a net credit provider when their accounts payable is higher than, when their accounts receivable is higher than accounts payable. So that means accounts receivable, you expect to receive more than how much you owe. You are considered a credit provider. Sometimes it's just the opposite. You are considered a credit user if your accounts payable is higher than accounts receivable. Smaller firms typically are credit users. So that was the theory related to trade credit, and next I'm going to work on a video on applications on this theory.